Welcome to AM Best Audio.
Severe climate events such as Hurricane Harvey continue to elevate risks for local businesses and the insurance industry. According to the research report, Financing Negative Shocks, Evidence from Hurricane Harvey by Benjamin Collier, Associate Professor of Risk and Insurance at the University of Wisconsin-Madison, along with Lars Powell of the University of Alabama, Mark Reagan of the University of Georgia, and Song Yu from Insurance for Good, independent firms face greater credit delinquencies, reduced insurance coverage, and limited access to recovery capital, while subsidiaries fare comparatively better. The research highlights a growing opportunity for insurers to develop products and strategies that strengthen financial resilience and support faster post-disaster recovery. I'm Lori Chortis for AM Best TV, and joining us now to discuss these findings is Benjamin Collier. Ben, welcome. So great to speak with you today. Thank you so much for joining us.
Thanks for having me, Lori.
So Ben, can you tell us a little bit about your research and what inspired the study?
So we had seen in many reports that following a disaster, lots of people don't have insurance, lots of households, lots of businesses. There's notable recognition in the industry about this catastrophe insurance gap. And that makes sense in the aggregate, but at the ground level, we wanted to understand more about what's actually happening to businesses following these events. So we organized a couple of sources of data about a year after Hurricane Harvey to better understand what's happening to these businesses. So one, we visited Houston, my co-authors and I, and met with businesses to try to hear from them about their experiences. And so even went to damaged businesses to their properties where they were up and running, or maybe in some cases there were still some signs of the event in terms of repairs. So we learned from them, and then we organized a survey and had about 250 businesses take part in that survey. And then we paired that data with credit reports, businesses' credit reports about their debt balances, whether they're paying their debts on time, and so on. And had around 8,000 businesses from the disaster area near Houston, plus Texas, plus the national sample to try to give us some comparisons between the heavily affected areas and the broader community. So let me tell you a few of the things that we found in this study. I'll start with the survey. So businesses, around 40% of them said that they had property damages themselves because of Harvey, but more than 90% said they had some sort of business disruption related to the storm. So this was often they had to shut down for a period, their employees couldn't come into work, the utilities were out, this sort of thing. Many businesses struggled. Around 45% of the businesses that we surveyed said they were still struggling about a year after the event. Some had said they think they'll never recover. There were a few that had closed permanently. Around 4% had closed permanently because of the storm. And I think that might be an underestimate, because a lot of businesses who might have closed may not have been around to participate in our survey. Their owners might not have heard about it, that sort of thing. Some of these businesses had insurance. Around 2/3 had some coverage for wind insurance. About half had flood insurance. And so some of them were receiving some insurance payments in this context, but there were a lot of damages that weren't covered by insurance. Either the business didn't have it at all, or they didn't have a payout, a claims payment that sort of addressed the full loss for them. So what were they doing? Many of them had some earnings and savings. They had some savings set aside, or they used earnings over the next several months to help fund repairs to their business. About half of businesses turned to friends and family to deal with the losses from this event. So, my expectation was businesses will have insurance. If they don't have insurance, maybe they'll have like a rainy day fund, or they'll turn to credit. But this friends and family piece was a big one. They were using sort of informal mechanisms to try to recover. And about a quarter of businesses use credit. So we have this kind of mix, and it looks like different businesses doing different things, but a number of them having to really cope in surprising ways to fund repairs to their business and try to move forward from the event. We do have information from credit reports too, as you noted, and around. And so we were looking at where these businesses were. We had their exact addresses, and there's spatial data on the depth of flooding at different locations, in the disaster area. So you can see for a specific business what the water depth was for them. And flooding increased delinquencies. So they effectively doubled business delinquencies in the most flooded areas and sort of above median areas in terms of flooding. And so I think this is a sign of financial distress. This has a lot of complications for business in the longer term. If you haven't paid your debts on time, it can increase your interest rate on future credit. It can reduce the chances maybe that you're approved for the loan down the road. And those negative effects are really concentrated in these independent businesses, think like the mom and pop kind of businesses. We're experiencing those subsidiaries of larger firms, so maybe the local Walgreens or the fast food chain or something like that. They didn't have the same negative effects on their credit report. I think which is suggesting to us that they had these additional resources available to them from the larger parent company. So we saw this different experience between whether it was a local business or a national firm.
Ben, what lessons from Hurricane Harvey can guide future disaster preparedness for businesses? And how can insurers better support small, independent firms facing severe climate events?
So we asked businesses that had insurance, did they receive a payment? Did they not? And was the payment about what they expected? Many businesses were surprised not to have a claims payment. So this was 1 year after the event, and some of this may have still been being worked out between the insurer, the policyholder, and the insurer. But in general, there were a number of people that were surprised that they didn't receive a payment, and or that their payment was smaller than expected. And this doesn't look like non-compliance necessarily. In most cases, this seemed like the policyholder maybe didn't understand the depth of coverage or the types of coverage they were being provided. They had damages on a piece of property that maybe they had chosen not to cover. So I think this is really difficult to learn if you think you have coverage and then you learn after the fact that you didn't when you have a loss. So I think this highlighted for us this really central role that agents and brokers play in making sure businesses understand the coverage that they have and that they're choosing it, thinking about what if that event happens, that you hope never does, but it does. What would you be covered for that? And if not, what would you do? And I think those are really helpful discussions for businesses to think about those trade-offs. Often these coverages are part of a larger business owner's policy. So they may have some property liability coverage, and especially in higher risk areas, I think the owners should be making sure they're covered for things like flood and wind if they think they're exposed to those risks.
Customize your data experience. BestLink now offers an interactive company dashboard that provides company-level intelligence in a fast, user-friendly interface featuring interactive tables, charts, and Sparkline performance histories. Customize the dashboard tiles to prioritize the insurer ratings, data, and analytics that best support your workflow. AM Best. Our insight, your advantage.
Given that firms in disaster-prone areas often face increased financial strain and higher credit delinquencies following these severe events, what strategies can help reduce these delinquencies and support ongoing business stability?
So I think we had some additional information that the paper that we thought about including the paper, and we just sort of ran out of space there. But businesses varied a lot in terms of their plans, their ability to, the extent to which they had some plan on how to navigate an event like Harvey if it occurred. So some of them had these disaster plans where they had backed up all their files, their employees knew what to do if they couldn't come into work, and then other businesses were scrambling in the moment. And so I think that there's a challenge for many businesses where they got into business to do something specific. Maybe they are a bakery or a tailor or something else. And the focus was not on thinking about events like Hurricane Harvey, but having a plan that involves, strategies to try to reduce losses, and then having financing to fund repairs, I think is a sort of a comprehensive piece. And one, again, where I think, an agent or a broker can play a valuable role in helping firms think about trade-offs in this situation. But even firms that are recognizing that credit or insurance might be an expensive way to recover. I don't know if I can afford to do that. There may be a number of things that planning helps in terms of mitigating losses.
How might the findings from this research shape firms' decision on coverage and capital today, given that insurance prices and interest rates are much higher than what we saw in 2017?
Yeah. So I think that this is a really challenging question for many businesses. If they're the things that are keeping them up at night are probably is not Hurricane Harvey or Hurricane Harvey kind of event. It's I'm competing with the business down the street, and am I going to continue to be successful going forward? Or maybe I'm competing with online retailers. How am I going to navigate sort of this AI and other types of opportunities, but also challenges for businesses? And so their concerns may not be on severe hurricane. And I think there's a reasonable view that businesses need to think about trade-offs in terms of what risks I cover and which ones I don't. And unlike households, businesses, if they need to close, they can close, and an entrepreneur can pursue a new business. So firms may take some risks, especially if insurance prices are high or interest rates are high, that they might not take in a different economic environment. So I think that's understandable, but businesses ideally are going into that with eyes wide open and knowing the risks that they're taking on. And I think part of what we're seeing in our study is sometimes businesses are surprised that they aren't covered for some of the losses that they are. So I think this planning beforehand is a really important piece. And that if businesses decide not to buy certain types of coverage, that they sort of are planning around that if a bad thing does occur, that they have other ways to try to fund repairs. On the debt piece in particular, some businesses, especially before COVID, before the pandemic, had taken out a lot of debt and were just sort of needed to keep paying those bills. And so we're more leveraged than I think businesses are today. I think recognition through the pandemic that there can be some pretty sustained disruptions to a business's cash flows motivated businesses to rethink how leverage they were getting. And that is potentially helpful in this setting too, where a major hurricane may disrupt operations for a while. And if a business has a nest egg and its finances aren't quite so tight, then that can help it manage a storm.
Ben, with many businesses experiencing gaps in coverage or insufficient financial protection after a natural disaster, how can insurance products be designed to improve post-disaster financial resilience and better support recovery efforts?
I think one of the things that stood out in our study is how many businesses were dealing with some sort of business interruption and trying to navigate the challenge that they're not bringing in revenues, or they have a bunch of additional costs that they don't typically have. So quick claims payments, I think, is important. Understanding if a business is covered for business interruptions. In some cases, it can be challenging for businesses to have coverage for things like flood-related interruptions. Many of the businesses that we were surveying would be buying insurance through the National Flood Insurance Program, which doesn't cover those interruptions. So I think a combination of being prepared with financial documents, having your insurer on speed dial, and then also knowing where the gaps are in coverage is going to play an important role.
Ben, what role should insurers play in ensuring equitable access to recovery funding?
So insurers are, first and foremost, they have their policyholders, and fulfilling their commitments and trying to do that in a way that paying claims quickly and working to fulfill those contracts, I think is really fundamental to keeping those clients and keeping this sort of strong reputation of insurance locally. And they have this obligation with their clients. I think that's really the central role they're playing in this disaster recovery process. There are many, many needs that are not covered by insurance. And I view those as very important, but also for a larger sort of public policy discussion in terms of thinking about gaps to insurance. Some of these gaps may be because people aren't focused on risks that they're vulnerable to, and so there may be arguments around that for encouraging or even requiring certain types of coverage. We do that in other settings, liability and for auto coverage and things like that. And there may be a larger motivation to think about in certain settings, you just really need to have that insurance coverage. Often affordability is a challenge where a business or a household simply just doesn't feel, or they may literally be unable to pay the insurance premiums that they would need to pay. And so I think there's a larger discussion that is really a policy discussion about how to address those issues, how we think about when a loss occurs, who's paying for it. And that discussion is a challenging one, especially in a context of growing risk, because we want to make sure that if people or businesses are locating in disaster-prone areas, that that we're not making somebody else pay for that. So this risk insurance price linkage is a really important one, I think, to maintain in those policy discussions.
And Ben, how can insurance executives, underwriters, risk officers, and others in the industry apply findings from your research to improve risk assessment, tailor products, and better support small businesses in preparing for and recovering from severe climate events?
I think that many of the businesses that we studied had this type of business owner's policy, which is I think a great policy. It bundles a bunch of specific types of insurance that a business would need: some property coverage, some liability coverage, if they have vehicles, some auto coverage, and so on. And it can be quite easy to to think of that as like a one-size-fits-all product. I think agents do try to tailor those, but understanding what are some of the specific needs in risk-prone areas, coastal communities, wildfire-prone communities, and so on, that there are a number of gaps in sort of this standard policies that insurers may be able to address with specific products. So specific flood products, specific wind products are the kinds of things I'm thinking of here for businesses that may help reduce the size of the catastrophe insurance cap.
Ben, this has been so interesting, so insightful. Your research is so fascinating. It's been such a pleasure, and I'd like to thank you very much for taking the time to speak with us today. Greatly appreciate it.
Thanks so much, Lori. It's been a pleasure.
That was Benjamin Collier, Associate Professor of Risk and Insurance at the University of Wisconsin-Madison and co-author of the research report, Financing Negative Shocks, Evidence from Hurricane Harvey. For AM Best TV, I'm Lori Chortis.
Looking to get the full attention of the insurance industry? We have the platforms that will do just that. Whether it be AM Best TV, AM Best Audio, Best Review Magazine, or Best Day. Find out more by calling AM Best Advertising Sales at 908-439-2200, extension 5399, and have a great day.